and welcome to another edition of Inside the Vault with Nick Barisheff, President and CEO of Bullion Management Group and author of $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. For the past several weeks, we've been asking our BullionBuzz e-newsletter readers to submit questions for Nick. BullionBuzz reader Chris from Calgary sent in this question about gold and deflation. Some people are saying there's no point investing in gold right now as there is no inflation. What do you think, Nick?
Well, there's a lot of confusion on this subject, so it's important to first clearly define what is inflation and deflation. Inflation is an increase in the money supply. Deflation is a contraction of the money supply. And by either increasing or contracting, that then affects the price of goods and services. So in this case, what we have is the Federal Reserve balance sheet is expanded by 3.5 trillion, roughly speaking, since 2008. So that's new money that's being created. That money has flowed in largely to financial assets, stocks, bonds, derivatives, margin accounts, real estate, art, exotic cars, and so on. Now, those elements are not part of what is normally considered as inflation and deflation. Those are typically referred to as bull markets and asset appreciation.
So are we in a period of inflation or deflation or somewhere in between? According to the mainstream media, the CPI index tells us there's no inflation right now.
What's important to understand is the CPI is just an index, and it has been changed over the years. So if one goes to get a clearer understanding of this, they can go to John Williams' site, Shadow Stats, and there's a lengthy report on the way CPI used to be calculated and the way CPI is calculated. So what it used to measure was maintaining a fixed standard of living. So you use the same basket of goods year after year and measured the price increases. That's now being changed to measuring the standard of living. And what they do is they substitute, they use various adjustments. So the CPI index, as far as consumer prices, is understated. And if you go back to using the old methodology, pre-1980, which John Williams posts on his site, we're currently running about 8% for the CPI index. But again, as I mentioned before, the CPI index is not inflation or deflation because it doesn't include all the areas where the excess printed money by the Fed went into over the past number of years.
So the Fed has expanded the money supply by $3.5 trillion. Is that money going into the economy?
Oh, very little of it. And what's happening is that clearly stock prices have risen because central banks all over the world have created money. It wasn't just the US Fed. Real estate has increased, and as I said, art, exotic cars. So the money has gone into these assets which aren't part of the CPI index. And those assets are all many people think, and I agree, is that they're in a bubble now. So what we've got is you've got increasing money supply, increasing prices in financial assets and certain other assets. But the CPI index is understated. However, if you look at some of the components of the CPI that everybody needs to deal with, like food, energy, medical bills, all those things have gone up in double-digit amounts. And if you were to look at calculating the CPI index according to the original methodology, you would be close to 8% as a CPI index today.
So back to Chris's original question then. Some say under these circumstances gold won't do well. Are they correct?
Well, that's another misconception. There was an in-depth study done by a fellow called Roy Jastrom And he looked at how gold does in inflation and deflation. And I think the time frame was from 1500s to now. That book was originally very hard to find, but it's now being republished and available at Amazon. But what he did was he found that gold actually does better in a deflation than in an inflation. Now that's counterintuitive, but what that means is that if we take financial assets, real estate, etc., that are currently overinflated and in a bubble, you could have a situation where gold declines in dollar terms, but it declines less than those financial assets. So from a point of view of purchasing power per ounce, in a massive deflation in financial assets, you could have a situation where the bullion in ounces is buying you more Dow, more real estate, more exotic cars, boats, trains, etc. And that's happened in the past, so the evidence is clearly there when one looks. It's just that it's counterintuitive that gold would do well in a deflation.
Thank you, Nick. And thank you, Chris, for submitting your question. Viewers, if you would like to learn more about CPI and how it's measured, be sure to check out John Williams' report on shadowstats.com. And for those who are interested in further reading about gold in a deflationary environment, BMG recommends The Golden Constant by Roy W. Jastrom. Thank you for tuning in. If you have questions for Nick, please send them in to info@bmgbullion.com. We look forward to answering as many as we can here on Inside the Vault.